Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar's title today is Effective Portfolio Management for Long-Term Stock Investors. Welcome to this session. My name is Shane Chu. I'm the moderator for this session. Now, today, we're going to look into how do we build and manage our portfolio, especially if we are long-term stock investors. And I also learned from our speaker today that today we're going to go through some intensive mathematics sessions exercise. All right. So before we begin the session and start the mathematics exercise, so here is the disclaimer. Whatever we share in this session is only for education purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to introduce our speaker today. He is none other than Mr. Ian Tai. Now, Ian Tai is the content producer for kclau.com. He has written over 250 articles on kclau.com, and he's also the weekly webinar host and presenter on it. He is also the co-founder of Dividend Vault, where he specializes in manufacturing savvy investors who can build dividend-based portfolios independently. He's a dividend investor and he primarily invests for dividend income, whereby his portfolio gain is about 2 to 8% dividend yield per annum. So it's very pleased to meet you here today, Ian.
Oh, hello, Shane. Hello, everyone.
Yeah, how are you?
It's an honor, a privilege to be here. Yeah, doing good. How about you, Shane?
Yeah, I'm good as well. So I will just hand over the session to you.
Yeah, sure. All right. So right now it's 8:40, all right? Or at least it's 8:37. So I have until 9:30, Shane. Is that correct?
Yes.
All right. So let's get the webinar session started. So because I've actually prepared quite a lot of materials, let's go through them quickly. All right. So I believe that all of you guys are actually looking at my screen. Okay, so this is actually the slide that Shane has presented. And now let me just carry on from here. Okay, so guys, just now I actually put in the chat box. If you can, actually please do, prepare a smartphone or a calculator right beside you, because we are going to do some calculation later. All right, so let's get into it. So today, this webinar, right, I kind of like prepare it for investors, because I myself, I'm an investor, and I'm not into trading or speculating in the stock market. All right. So if you ask me anything about trading or speculate, or how do you actually speculate the stock market, I may not know, or I would not know how to do all those kind of stuff, because I myself, I'm just focusing on long-term investments. All right. So basically, what I mean by investing is this. So my style, my plan, my strategies are as followed. So for me, right, I don't actually trade stocks, like for example, I don't buy a specific stock at a certain price, let's say $1. And then I'm actually thinking about how can I actually sell it for $2. So that's actually not my mindset. So my mindset is actually more towards accumulation of shares of good businesses. All right. So which means say after, let's say, X amount of years, maybe 2, 3, 5, 10 years down the road, how many of these good shares, how many shares can I actually accumulate if, let's say, I like the company? All right. So that is actually my game plan. And for myself, right, specifically, I'm a dividend investor. So which means say what I will do is that what I'm focusing on is actually on income productivity of a stock. All right. So which means to say I'll be looking at the stock's profits, cash flow, and of course, the best part of being an investor is to actually receive dividends. All right. So that's actually my game plan. So guys, if let's say you're into short-term trading or speculating, maybe what I'm going to share with you for the next 50 minutes or 60 minutes or so may not be so suitable for you. All right. So with that, let's carry on. Contents. So today we're going to talk about 4 things. The first one would be, why do people actually buy high and sell low? So I'm gonna just explain it from the long-term investors' perspective. So I'm actually going to attempt I'm going to attempt to actually explain why people tend to do that. All right. And next part is that after I've actually shared how people tend to buy high and sell low, I will then share how you can actually make better investment decisions. And with that said, right, I'm going to go into some case studies where that will be the third and the fourth part of the webinar session, where I'm going to just give you an example, give you some, some brain teasers and stuff like that to actually determine. And this is actually very important when it comes to portfolio management, which is to address questions like, what if the stocks that I've actually purchased, right, they have risen in prices? And of course, the fourth one, which is actually quite common, which is what if the stocks that I've purchased, right, have fallen in stock prices? Okay, so typically for stock investors, especially if you have done this for a very long time, it's actually very normal for stock prices to go up and come down. So you need a strategy to actually handle these two scenarios. Okay, one for stocks that have actually increased in stock prices, the other one for the stocks whereby their prices have already declined. Okay, and of course, for this webinar, right, if you have any questions in mind, just put it in the Q&A box. I would love to actually address as much as I possibly can, all right, your questions. So just put it in the Q&A box. Okay, so let's start with part one, buy high and sell low. So the question is this. So why do people actually buy high and sell low? Now, I'm going to just sidetrack this question by asking another question. Okay, maybe you can actually type in the chat box. All right, so here's the question. How do you measure investment performance? So let's say, for example, you buy a stock today, and what makes you think that this stock, right, has actually performed well in the stock market? Perhaps you can actually type in the chat box. Let me know what are your thoughts about this. Okay, so there's the first one, which is Muhammad Daniel. So, or Muhammad Daniel. So it says capital gains. Okay, fair enough. So that's actually one of the key metrics that people actually use to measure success in stock investing. So we have TH Steel. It says dividend yield and capital gains. And then Ginseng Tong says CAGR. Okay. Bernard says average yearly return. Okay. So Albert Mann says a mixture between capital gains and dividend yields. All right, fair enough. So basically that is actually the typical ways of how people actually measure investment performance. Okay, that's very good. Now let me just continue with let's just play along with my theory for a second, yeah? So how do you actually measure investment performance? Sorry. Now, here's the thing. Okay, now let's make this a more interactive session. So the question is this: do you agree this? So let's say, for example, if you buy a stock, all right, and let's assume that you kind of like believe that stock performance, right, is actually based on price performance, all right, which means it's actually based or measured based on stock price movements. So the thing is this: if let's say the price of a stock that you actually purchased has gone up, then you consider that as good performance. And then on the flip side, if let's say the price of a stock has actually come down, then you will view that as bad performance. So how many of you agree to this? Take a look at this statement, all right? How many of you kind of like agree that this is actually the DD way to actually measure stock price performance? Put it in the chat box if you agree. And if you disagree, you can also put it in the chat box. Okay, so Chen Wong Tang says no, Simon Wong no, okay, Siu N Giam no, Peter no, Zachariah Thomas no, disagree. Okay, wow, so many disagree, not the way, yeah. But the thing is that all right, whoa, so many people say no. Okay, fantastic. All right, but then there are, as much as most of the responses here have points out that actually this is not the right way to measure price performance, but the truth is, in the market, that's how people actually measure it. All right, so people tend to, so let's just assume that most people in the stock market tend to assess or tend to measure stock performance based on stock price movements, whereby if the stock goes up, it's good good performance. If the stock price has come down, then it's bad performance. Let's just play along with this theory. Now, here is actually a stock whereby it is actually a stock. It's a public listed company in Malaysia, of course. As you can see, there's KLSE, there's Berhad. I just omitted I just want to shut the or close the what you call the actual identity of the stock. All right. So the key thing is this. All right. Stock price goes up. So does that mean that this is good performance? All right. So many people will say that, hey, if you look at this kind of stock price movements, right, it's actually going up, and therefore this is called good performance. And then for these people, if let's say the stock price has actually gone up here and they come down, so to them, like right now, what you see here, so does that mean that this is bad performance? Okay, so if you're playing around with this kind of logic, so you may actually tend to form this kind of conclusion, which is so big, which is so much based on stock price movements. Okay. Now, here is the thing that I would like to bring it up to you guys. If let's say, for example, some of you guys, I know most of you, 100% of the comments here says disagree, but let's play along and say, let's assume that if you agree to this, and if you think that if stock price goes up, it's called good performance. This is because the prices has actually gone up. There are capital gains. All right. Therefore, because of that, people tend to actually buy. And on the flip side, when stock prices come down, you will view that as bad performance. And why is it bad performance? Because you hear a lot of stories of people losing capital in the stock, losing their capital, their money in the stock market, buying that kind of stock. So therefore, because of that, the sentiment has actually changed. And because of that, people tend to sell. All right. So I believe this is actually the reason why people tend to buy high and sell low. All right. So this is of course not the playbook of an investor. What I've actually described just now, all right, it's actually a playbook more towards for people who do not know much about stock investing. They may come in trying their luck in the stock market, trying to speculate stocks, and they may actually they may try out their what do you call their game in terms of a stock trading. So this is actually how people think, all right, or at least this is actually the kind of behavior that I behavior that I observe among people. So when stock prices go up, they tend to buy because they think that this is good performance, and when stock prices come down, they will see that as bad performance, and therefore they will sell. So there are such people in the stock market. So, and I believe that by observing this kind of behavior, I believe that is why some people tend to actually buy high, and they tend to actually sell at a very low price. Okay, so that's actually the first part. Now, let's move into part number 2. So the question is this: if let's say how conventional people actually think, if let's say, for example, if you agree to that kind of thing, I know that most of you don't, which is very good, okay, because most of you guys are more learned. So let's assume that people actually tend to think that way. So now the question is this: if you tend to think that way and it didn't really work for you, the question is, how can you actually make better investment decisions? So this is something that I would like to actually propose to you guys, a mindset, the framework on how actually investors think. All right, so let's go into part number 2. So part number 2 here, I'm going to answer this question, which is, how do I actually measure investment performance? So this is actually my own personal take on how I measure investment performance. So let's assume that I kind of like buy a stock today, or let's say I make an investment into a stock. So for me, for me personally, the way I measure stock is actually as follows. Okay, so just now, guys, I mean to say, just now part 1 is actually more towards explaining to you guys on how I view what most people are thinking. All right. So right now, it is actually the thing that I really do in order to manage my in order to manage my own portfolio. So this is actually the slide that you may want to actually pay the most attention. So, and this is actually how I measure investment performance. So my style is this. I measure performance based on the stock's income productivity. So income productivity for me is measured based on a few things. Number one, profits. Number two, operating cash flows. So to me, if let's say I buy a stock and after I bought it, the stock's profits or its earnings and its operating cash flow has increased over time, then I would say that the stock has performed well. All right. So it is actually kind of like regardless of what happened in the stock market. So I'm not so fixated on the stock prices. All right. I'm not actually looking at the stock prices to determine the performance of my stock. The performance is actually based on earnings and more importantly, it's operating cash flow. Okay. Now, guys, this is actually very important. Sidetrack a bit. A lot of people actually tend to look at earnings and earnings per share, which is okay. That's the first line. All right. But it is actually because a lot of people know that people kind of like focus on earnings and earnings per share. Therefore, they may actually try to beautify this, but they forgot that there's always a second line of defense, which is a cash flow part. All right. So if what I'm trying to say here is that if you see that there are companies where the earnings are very good and people tend not to look at cash flow statements, operating cash flow. If you see that the company's earnings are good, but there's no cash flow coming in, I may not like that kind of stock. But for me, I want both, two things, the profits and the operating cash flow. Both of them must be increasing over time. Both of them must be positive. If that's the case, then I'll say that's good performance. Otherwise, if let's say the profits and its operating cash flows are declining, then I would say that is bad performance. So it's all based on income productivity. It's all based on cash flow. Okay, so that is actually how I measure stock performance. Okay, so let's say, for example, this is again a real life stock, all right, that is actually a public listed company in Malaysia, whereby I have concealed its identity. So if you look at its earnings, all right, so this is actually how it looks like. If it's earnings and if it earnings operating cash flow looks something like this, I would say this is called good performance. Okay, so all the stocks that I purchase should look something like this. Okay, when it comes to its earnings. Now, this is actually another example of a public listed company in Malaysia, whereby this is how its earnings figures look like. So it has a good growth all the way up to 2012. And subsequently, it couldn't actually live up to its past glory. And then it was kind of like badly affected by the pandemic in 2020, 2021, and 2022. So in this case, right, all right, because its earnings couldn't keep up with its past glory, I would say that this one, the performance is actually not too good. And I may not, and very obviously, as a long-term investor, I may not want to include this in my own portfolio. So I like A Berhad, but I don't like B Berhad. All right. And as you can see here, it is actually based on long-term earnings, long-term cash flow. It's never short-term. It's never a 1-2 years thing. It's a multi-year thing, like a 10 years thing. And these days, because I've done this for quite some time, that's why the amount of data that I have actually compiled is actually more than 10 years. It could be 10, 11, 12, 13, 15 years. All right. So therefore, I tend to look at that kind of length when it comes to assessing a company, because I've done this for quite some time. Okay. Now, just play along with me. Yeah? Because of my way of measuring performance, whereby I measure performance based on profits and cash flow. If let's say profits and cash flow increase consistently, I will view that as good performance. And if let's say this company, right, the productivity increases, I'll be more and more interested to actually buy that kind of stock. and therefore I will buy. I will invest more and I will add more to that position. I will add more shares into my portfolio for that company. Okay. However, if let's say I find out that there is a company whereby I have purchased it, but then over time, I begin to realize that the profits and the operating cash flow kind of like declines, kind of like reduce over time for the long term. And it is actually a problem that has persisted for a long term. I will view that as bad performance. And because of its decreasing productivity, I tend to sell off this kind of stock. So you can see here, this is actually my way of thinking. And my way of thinking is actually based very much on what is being reported on the financial statements. And it's actually not so much based on the stock price. Okay, it's all based on finances. Okay, so therefore, today, as an investor, in my own portfolio, what I will do is this. I tend to focus very intensely on increasing the stock, on accumulating stocks that are increasing their income productivity. So I just focus on income productivity, and it seems that everything works pretty okay lah. All right, at least from my own case, for my own portfolio. I just need to focus on the fundamentals, and the rest of the things, the dividends, the returns, and whatnot, they'll just come naturally. All right. So what I'm saying is that the returns and dividends come naturally, which means all I need to do is just I focus on the fundamentals, make sure that I get the stocks right, make sure that the stocks continue to be income productive, continue to increase its income, its profits and cash flow, and naturally, sure enough, the dividends will come in. Sure enough, if let's say over time, I hold it long enough, the business expanded, then the valuation of the business will also reflect upon its long term. So therefore, I don't need to really focus so much on the returns. I'll just focus on the income productivity of the stock. Now, this is actually where the fun part is. So the thing is that I like to actually play a game with you to see what you guys think about this. So right now let's just actually prepare a calculator and a smartphone, and I'm gonna go through a case study, 2 case studies with you. It's more like a testing ground for all of us. So let's just play a game, and let's just have fun. All right. So this is part 3, whereby I'm going to address this question. I'm going to just address this. Let's assume that I purchase a stock, and the question is, what if the price of this stock, right, had increased over time? All right. What happens? What should I do? Okay. So the obvious question is this: should I sell? Should I keep? Or should I buy more? Right. Now, this is actually a question whereby I have already owned a stock. All right. So let's say I own something. I own a stock. I own a certain amount of shares of that stock. And now the question is, should I sell it off? Should I keep? Or should I buy more? If the share price has actually gone up. So what do I do? Okay. Now, let me just explain the scenario. And then perhaps you can actually put in the chat box, what do you think about this? All right. Now, once again, conceal the identity of the stock. It's definitely a Malaysian listed company. It's a Berhad. The stock price is in ringgit. And here's the thing. Let's assume that I have actually purchased this stock. I wish that I purchased this stock, all right, sometime before 2010. And let's say I bought it at 5 ringgit. Okay. So I bought this stock at 5 ringgit. And over time, I hold onto this stock. It kind of like increased in stock price all the way to 12 ringgit and 50 cents. Okay. 5 ringgit to 12 ringgit and 50 cents. Of course, 5 ringgit and the 12 ringgit and 50 cents are stock prices just so that I can conceal the stock. Now let's just play a. I have purchased a stock in 2010, whereby the stock price is $5. I hold it up for quite some time, and right now it's 12.50. So the question is, so now the question is this: should I buy more? Should I sell? Or should I just keep? Type in the chat box. Let me know. Okay. So now the thing is this. Guys, I kind of like see this. There's some questions that are being posted in the chat box. Your questions will be drowned in the multitude of comments. Please do copy and paste your questions and put it in the Q&A box, all right? So that I can address them efficiently after this presentation, right? Okay, so a lot of people says keep. So Siu N say keep. Lo Ching Min says keep. Siu Kyong Fan says sell. William sell. Chin Min says keep. Wong Yifai sell half. Peter Ling sell some. Sell 50%, sell half. Keep if financial is consistent. Keep, sell or hold. Depends on the whole picture. All right, so Bernard says if profit and cash flow increase, then hold. Ng Seng Hock says buy some more, sell, and so on and so forth. Okay, there's so many comments that comes in. That's really, really good. Monitor daily closing prices and put stop sell at 5% below closing price or new. Okay, fantastic. Now, very good comments. Now I'm going to just share mine and let's see. So a lot of people seems to be very interested to sell. Now, here's my take. Here's how I assess things. Okay. So the question is this: which will you choose? Many people actually choose option 1, which is to sell at 12.50. Some says keep, right? And there's very few people who actually says buy more. All right, fantastic. So the thing is that, guys, your answers may be correct, but then when it comes to the reasoning, it's another thing. All right. So here I'm going to just review something which is actually more towards investors. Okay, because there are some people who answer based on based on trading activities, which is something that I don't do. All right. So I'm an investor, so I do the investing way. All right. So here's my take. So personally, it doesn't matter what stock price. There's always a checklist to follow. Okay, so this is the part where you need to pay attention. So this is how I do it. Checklist. The first, did A achieve an increase in income productivity? Okay, that's the first one. All right. So I don't care about the stock price. Let's focus on let's focus whether or not the income productivity of the stock has increased or not. So that's the first one, the first question to be answered. Then after that, what I will do is that I will track back in 2010. I will want to know what was the valuation of A Berhad when I invested it in 2010. Okay, the valuation at the time. And then I will compare it with the current valuation of A Berhad today. So now I'm going to share with you how I do it. So question number 1, did A Berhad achieve an increase in stock income, achieve an increase in income productivity? So based on its earnings figures, okay, so let's say I bought it somewhere around here when it's actually making 2.5 billion. So let's say in 2009, so it made about $2.5 billion, 2.5 billion ringgit. And on a yearly basis, it kind of like achieved consistent growth in earnings from 2.5 to 3, 3.5, 3.8, all the way up to 2018, where it has actually achieved 5.591 billion ringgit. So the first question is this stock, has this stock achieved an increase in income productivity? The answer is yes. So that's tick, all right, for question number 1. A good tick for question number 1. Now let's move on to question number 2. So back in 2012, okay, so back in 2010, let's say the stock price is actually at 5 ringgit, all right, So agak-agak lah at 5 ringgit. The earnings per share at the time is, let's say I put in a fictitious figure, let's say at 0.3, that means it says 0.367 ringgit, so which is 36.7 cents lah. So I take 5 ringgit, I divide it by 0.367. Therefore, I will get a PE ratio of 13.6. Okay, so that was the valuation I bought it at the time. Now I will have to compare it with the current. Okay, so now I need to actually compare it with the current. So the current price is actually 12.50. I'll take its latest earnings per share figure, which is 0.722 ringgit, which is also 72.2 cents. I'll take 12.5 divide by 0.722, and therefore I will have a PE ratio of 17.3 when it comes to its PE ratio. Okay, so can you see that in this case, not just the stock price has actually increased, but then the PE ratio, all right, in 2010, the PE ratio was 13.6. Now the current is 17.3. Okay, so which means to say, in this case, the valuation has actually gone up. So most likely I may not actually buy more. All right, so because why? The valuation back then was actually more attractive than today, than the current. All right, so therefore I may not actually get in. I may not actually want to buy the stock at 12 ringgit and 50 cents. So buy more is out of the question because the valuation has become more expensive. And now there's another part to it. What I will do is that I will actually calculate the past historical PE ratio for Eberhard, okay, over the past 10 years. Okay, so how do I do this? So let's say, for example, for this one, the 14.66. How do I get 14.66? I'll take the closing stock price at that time, which is 2017, and then I will divide it by its earnings per share in 2017, and therefore I will get the PE ratio for 2017. And for 2016, let me repeat, I'll take the closing stock price for 2016, and then I will divide it by the earnings per share for 2016. And that's how I get 14.63. And then I just continue, on for the latest 10 years. All right. So here is a long-term data when it comes to Eberhard's PE ratio. And what I've gathered is that the average PE ratio is around 14.75. But then for 2018, all right, for the current one, the PE ratio is 17.3. So since the 2018, the price, 12 ringgit and 50 cents, is valued at a PE ratio of 17.3, which is higher than the average PE ratio of 14.75. So this is actually a double confirm that I will not go in and buy more of Eberhard's share. All right, because the valuation has actually gone up already and is actually above its average. When it's above its average, it's not exactly fair valuation. It's kind of like a little bit overvalued. So I may not want to go in. All right. And as a result of this, all right. Yes, so this graph actually kind of like proves it. I have actually jumped the gun. So at this price, I may not buy because I view it as a little bit overpriced or a little bit overvalued, expensive. So I may not want to buy. But the thing is that what I will do is that I will either keep it or I may actually sell it at 12 ringgit and 50 cents. So these are the two options that I may actually be more keen to go with as compared to option 3, which is to buy more at 12 ringgit and 50 cents. All right, so that's actually my way of looking at things. All right, and from Muhammad Daniel, yes, you say closing price as of 31st December lah, or 30th December. That would be good enough. Correct. All right, so here's the thing. I don't look at stock price. to evaluate us. I don't look at stock price to determine the value of the stock. I take the stock price and then I calculate the PE ratio and the dividend yields. Okay, this formula I tend to, so just now what I've shown you is actually the PE ratio. I also do the same thing with dividend yield. All right, so you can actually use these two, and from there you can actually make your own conclusion as to whether or not you should buy more, should keep, or should sell. But specifically for this case, I would say that I will be more inclined to choose option 1 or option 2. All right. So which means to say I will either sell it at 12 ringgit and 50 cents, or I may choose to keep. Okay. So that's actually my take. So for Peter, who says dollar cost averaging, that's partially right. Okay, because I don't tend to simply dollar cost average. So like, for example, now I already know that I already calculated the current PE ratio is 17.3. All right, 17.3 is higher than the average PE ratio of 14.75. So I know that I'm not getting a good deal for A Berhad as much as I like A Berhad. So if I like A Berhad, but then the price is not right, I don't think it makes perfect sense to actually go in at dollar cost lah. You only dollar cost if the price is right. If the valuation is right, then you can dollar cost. So it's a bit not so much of a dollar cost, but it's more like a value cost. So the whole idea, the game plan is not so much you can dollar cost, but make sure that you can dollar. Okay, let me put it this way. You can dollar cost, let's say for an undervalued stock, and it can work very well for you. However, if let's say your dollar cost on something which is overpriced, no matter how you dollar cost, you are very subjected. Okay, you're putting yourself at risk of having capital losses, because why? You are buying something which is overpriced. All right. So when you buy something which is overpriced, of course, no matter how your dollar costs, it may not turn out very well for you lah. I mean to say, especially if you tend to always buy something at super over value price. Okay. So when it comes to dollar cost, use it wisely. All right. There are certain conditions that you can use when it comes to dollar costs. All right. So this is actually the first part, all right, whereby I explain how I look at things. Now let's look at the other part, all right, which is part number 4. Part number 4 is actually this. What if, let's say, I buy a stock and then the price of my stock had decreased? Okay, the price of the stock have decreased after I've actually purchased it. What should I do? So the question is this: should I sell? Should I keep? Or should I buy more? It's always the same question, all right? It's always the same question: should I sell? Should I keep? Or should I buy more? Now, let me explain further on the scenario. All right, so once again, we are now back to the same company. So as you can see, all right, let's say I buy it over here at $5. It went up, okay? And here was 12 ringgit and 50 cents. But then, unfortunately, let's say I choose to keep it. Let's say I choose to keep it because I'm a long-term investor. And now this stock, right, has actually dropped to 7 ringgit and 90 cents. So if you look at how steep this is, I don't think there's any chance. I mean to say there will be chances for you to cut loss and whatnot, but I didn't really cut loss. I mean to say, let's assume that for this case study, right, you just hold on to it. Like you want to own the company shares for life. Okay. And right now it is at 790. So the question is this: do I sell? Do I buy more? Or do I just keep? So what do you say, guys? All right, so Peter says check profit, operating cash flow, and valuation. All right, fantastic. So now I believe that Peter gets the picture. So now it doesn't matter what the stock price. It's not so much about the stock price, whether or not a stock price decline like this doesn't mean anything. All right. It doesn't mean bad performance. Okay. It doesn't mean bad performance. It can mean a lot of things. So the first thing to do is to go through the checklist. Same old checklist. All right. It's the same old checklist. Now, the checklist says, question number 1, did A. Berhad achieve an increase in income productivity? Question number 2, the valuation of A. Berhad when I invested it in 2010. And question number 3, what is the current valuation of A. Berhad today? Okay, let's take a look. All right. So by looking at this checklist, right, then you can actually determine whether or not you should be selling off at 790, or whether or not you should keep, or whether or not you should buy more at 790. So here's my take. Number 1, okay, so here you see, so this is A. Berhad. So I bought it around here, whereby its earnings actually increased all the way up to 5.591 billion. So this is in 2018. Now, there will be 2019, and there will be 2019. There's at least one more year, or 2020. So let's take a look. All right, so that's just 2019. So from 5.59 billion, now after 1 year of keeping it, the stock has actually, A. Berhad has actually reported 5.51 billion in terms of earnings. Okay, it just maintained. There's a slight decline, but then in general terms, I believe that I will view it as maintained in terms of profitability. All right, but over the long term, if you look at this graph, it's still looking good. A. Berhad is still very much a profitable company. However, the problem is that its stock price go from 1250 and it dropped all the way down to 790. Now what, right? But going back at the checklist, we can find out that question number 1, did the stock actually maintain its income growth? I would say yes, still okay, not too bad, A. Berhad. So its fundamental is still okay. And now let's look at question 2 and question 3. So question 2 is about the past valuation, which is in 2010, whereby the PE ratio at that time was 13.6, which is already calculated. But now let's look at the current valuation. So this is current. You see the stock price is 7 ringgit and 90 cents. The earnings per share in 2019 is actually 71 cents. Therefore, the PE ratio is 11.1. Now, I would like you to pay attention on this part here. Can you see that the stock price here, 5 ringgit, and the current, which is 790. 790 is still higher than 5 ringgit. All right. However, just because 790 in terms of stock price is higher than 5 ringgit, the PE ratio is actually lower. Stock price increase, but then the valuation is now cheaper. All right. How many of you are following? Okay. How many of you are looking at this? All right. Let me repeat this. Stock price current is higher than the past. 790 more than $5. But then the PE ratio has actually gone down, has gone below what it used to be in the past. Okay. For most people, they look at stock price. All right. They look at stock price and say 790 is more than 5. Therefore, they say capital appreciation. Very good. Then therefore, they may want to sell. Bye-bye. Because they look at stock prices. But then if you look at PE ratio, now the valuation is so much cheaper. All right, the valuation now is so much cheaper than in 2010. So therefore, this is very attractive to investors, especially those who like to accumulate A Berhad shares. So let me explain the psychology of different point of view. The thing is, let's say someone bought it here at $5. It goes up to $12.50. All right. It goes up to $12.50 and then it dropped to $7.90. Psychologically speaking, $12.50 dropped to $7.90 in such a short period of time. Some people may be tempted to sell, thinking that, hey, at least I get it out. At least I get it out at $7.90. At least I say bye-bye. I jabut at $7.90. And then at least I can actually get a little bit of capital gains. All right. Last time I get more capital gains if I can actually sell it at $12.50, I get more capital gains. But now it dropped so fast to $7.90. I do not know what's going to happen tomorrow. Therefore, when it's still at $7.90, I better sell. Psychologically, some people may think like that. But if you are an investor, you tend to look at things from a PE ratio point of view. And when you look at PE ratio, $7.90, PE ratio at 11.1 is at better valuation as compared to 5 ringgit in 2010 when the PE ratio is 13.6. Okay, so this makes A Berhad at $7.90 very attractive. So I'll probably say that option 1 is off the charts. I probably will want to keep A Berhad. Okay, so that is at least, so option 1 will be out, and now it's just option 2 and option 3. So which one is actually a better option? But I'll be more likely to actually choose option 3. But let's see. Let's play along. And once again, like always, don't just take the current valuation. I will still use the latest 10 years kind of PE ratio, all these figures, all right, to actually look at whether or not the current PE ratio is actually above or below its average PE ratio. Okay, let me explain. So now I go back to part 3. Can you see that this is A Berhad? All these figures are the same, but the average PE ratio here is 14.75. Why? Because it's the average ratio from 2008 to 2018, somewhere around this range. Okay. But now I go back to part 4. Now I will probably include this year, which is include this PE ratio of 13.69. Therefore, the new average of PE ratio has dropped to 14.66. Okay, there's a slight drop lah. So I tend to, every single year, I tend to update this kind of figure so that I kind of like have a brand new average PE ratio on a yearly basis. And based on these figures alone, what I can see is that the current PE ratio is 11.1, which is definitely below the average PE ratio of 14.66. So therefore, here's my take. What I would do here is, at $7.90, I'll be more interested to buy more of A Berhad shares, as I believe that at that time, it is actually undervalued. So therefore, if I have the capital, I will pick option 3, which is to buy more at $7.90. But if let's say I don't have any capital, then I will just keep whatever I have. I will not sell. So the ideal option is option 3. The lesser ideal option is option 2. Option 2 is actually more like I don't have capital to add more, so you just keep. Option 1 is actually for people. Option 1 is not in my favor, not not a good time to actually sell it at 790 lah. Not very good. Okay. So because of this, okay, now perhaps you can actually understand a little bit of what I have been doing and how I actually like decide which stocks should I keep and which stocks should I sell. It's all based on the fundamentals and the valuation. What happens is this: when I keep on doing this, I tend to only invest in fundamentally good stocks. And fundamentally good stocks simply means profits and cash flow. The balance sheets are all super, all very nice. And I always focus on valuation, whereby if let's say the valuation is expensive, not stock price expensive, is PE ratio. Is PE ratio, dividend yield, and all this kind of stuff. If it's expensive, I won't buy. If it's cheap, I'll be more interested to buy. So now the question is this: what happened subsequently? Now let's look at Aberhard. Just now we have the first scenario and the second scenario. Let's see how it all play out. Okay. Up to Aberhard. So the first case study stops here at 5.59 billion. Case study number 2 stops here at 5.51. Of course, this stock was a little bit affected in terms of profits during pandemic, but during pandemic, it kind of like made 4.87 billion. So I would say that it's still pretty good, considering that during pandemic, a lot of companies are going down and under. This company still can make 4.87 billion. I would say still not too bad. 2021, it recovered. So it kind of like made 5.66 billion. And 2022, it makes 6.12 billion. So I would say that Aberhard's fundamentals is still pretty good, pretty superb. So it's definitely the stock, the kind of stock, or the only kind of stock that I would like to keep in my own portfolio. Now here is what happened. Okay. So based on the way or the methods that I use to actually decide whether or not I should buy, keep, or sell my stocks, what happened is this. So if let's say I choose to buy more here at 12.50, till today, I will still have a capital loss, because right now the stock is actually at $10. Okay, the stock is actually at $10. But if let's say I choose here, let's say I choose to buy at 7.90, what happened is that over here, I would actually make the gain. I will make a capital gain. Okay. Of course, I didn't really purposely go and focus on capital loss or capital gain, but just simply by focusing on the fundamentals and the valuation, all right, by focusing on valuation alone, I can avoid myself from getting massive capital losses, all right, because if it's here, I won't buy. If it's here, but then the thing is that by focusing on valuation, I will be more geared to actually buy at 7.90. And because of that, the capital gains will just follow. All right. So why the company can actually go from 7.90 to 10 ringgit? Is there any logical explanation? Well, in a way, yes. Simply because if you look at the company's profits, the company's profits, the income productivity has recovered after the pandemic. And because of that, the stock price actually reflects, the stock price recovery kind of like reflects the recovery in business profits. So now, just want to conclude whatever I have presented. Hopefully I have actually made clear my style of investing and stuff like that. Hopefully I've actually imparted some of the experiences or observations that I have when it comes to investing in the stock market. And here are some of the conclusions that I've gathered. All right. So there are 4. Number 1, actually, right, how you invest, all right, is actually very much determined by how you measure performance. So if you keep on looking at stock prices, it will kind of like dictate how you invest in the stock market. You become productive, you look at stocks, you will at stocks, it will change the way on how you invest. And therefore, you will kind of like invest very differently. So the question that you may want to ask is this: which one would be a more practical way for you to measure stock performance? Is it based on stock prices or is it based on income productivity? That one you have to decide. Number three, the thing is that if you kind of like measure stock performance based on stock prices, you may be more prone to actually get caught in a mania, buying stocks at a high price, and then during panics, you may sell off the stock at a very low, at a much lower price because you kind of like being affected by all these negative sentiments and whatnot. All right, and all these things are not what investors do, but investors are aware of all these things, and because of that, plus investors tend to focus on valuation and the fundamentals. That's why the investors they can have more confidence when it comes to buying good stocks, and they always tend to buy it at a more attractive price as compared to most people in the stock market. All right, so that's my take. Hopefully you have benefited from this presentation and this webinar session. So I would like to thank you for your attention. Hopefully you have learned something today. And with that, I'll pass the control to Shane.
Thank you so much, Ian, for your wonderful sharing about this topic. So if any questions to ask our speaker, please write them in the Q&A box, not the chat box. Write them in the Q&A box so can effectively manage your questions. The first question on my screen, Ian, is that how do we analyze operating cash flow? Do we do it on a quarter by quarter basis or we compare it annually? This question is by Simon.
It will be a lot of work if you want to do quarter by quarter. So I will do annually. I mean to say, if I haven't buy the stock, I will look at it for the past 10 years, because a stock that is profitable a stock that has actually grown its profits over the past 10 years, right, should actually increase its operating cash flow. It cannot be one, a stock actually has increased its profits for the past 5 or 10 years, but then when it comes to operating cash flow, it's negative. Cannot be one for at least for 10 years. All right. If you find that kind of company, I will probably dismiss it because I like it when profits are pretty much back with operating cash flow. So I look at the annual past 10 years. And after I buy the stock, I will just track it on a yearly basis. That will be more than enough. Yep.
I think that would be a red flag to our, for the company. Like, it doesn't seem logical that if your company can be growing the profit every year, but they got a negative operating cash flow, right? So maybe they could be implicated in any, accounting book cooking, all right, to sugarcoat the numbers. Anyway, so this could be one of the red flag, right? So the next question is, do we need to consider net profit and operation cash flow after the working capital?
Okay, so operating cash flow, right, is reported, is always the net operating cash flow. So okay, I'm looking at two things. All right. Typically, the net operating cash flow is always reported after working capital. So after they have adjusted for the working capital, then they will come up with the final operating cash flow figures. So if that's the question, then I'll say yes. Yes, you need to consider both.
Thank you, Ian. The next question is, let's say the profit and the cash flow have dropped for a year,
Mhm.
would you exit or you wait for the second year? Confirm.
No, it's
Exit immediately.
it's just I'm not exit just like that lah. I mean to say, you have to look at what are the circumstances. You have to stand in like as if you own the business. So when you own the business, now let's say we have pandemic, you know that there's a pandemic, okay? So let's say, for example, you buy into some companies which is related to retail, and then you know that the government has implemented MCO, and then shops couldn't be open. And because of that, profits are a bit low, and there's little operating cash flows to show because of MCO. Does that mean that the business is actually bad? The answer is no, ma. It's just because of that circumstances. That's why it happened, lor. So which means to say we have to also look at that reasoning, at that kind of a justification why it happened. And if you can accept the justification, that I would say okay lah. But if let's say you are just looking at numbers, and then you just you just look at the numbers and say, oh, the numbers are going to be bad, let's cabut or something like that. That is not something that I do lah. Because the whole goal here is to own the company's shares for the long term.
So you are a bit more flexible if they underperform comparing to the previous year due to the macro environment that are deteriorating. I mean, you're fine lah, huh?
Yes, I am actually quite fine lah. I mean to say, as long as the reasons are logical, justifiable, and I can accept it, then good enough lah.
All right. The next question is by Theo. How do we do valuation? Do we look at price to earnings ratio and EPS?
First, you need EPS to calculate PE ratio, because PE means price divided by EPS, right? So I look at, typically I use a lot of PE ratio and dividend yield lah. All right. But like what I've shared just now, it's not just the current, you know. I don't just look at the current. All right. So this is current. Okay. But then I look at also the past. And then I also look at the average PE ratio. So I look at this kind of stuff. Okay. Because the current doesn't tell me a lot of things until I have the past historical PE. Then it can tell me a lot of things about the company already. So that would be good lah.
All right. Thank you so much, Ian. Yep. Now, do you calculate PE based on the average of 4 quarters or based on the annual report in that year?
Not the average lah. Just take the 1, 2, 3, 4 lah. As long as the figures are logical, it's justifiable, then good enough lah. Okay.
You mean the recent 4 quarters?
The recent 4 quarters will do lah.
Okay.
But put that on caveat lah. Of course, like unless you're talking about like last time we have the glove companies, you go and do that. You know that certain period of time, the latest 4 quarters is actually, you know, because of the pandemic, glove demands just shot up just like that. And then the glove companies are making a lot of money. Will I use that? I probably won't use that lah, because I know that it's an anomaly ma. So when I evaluate a company's business, the valuation must be from, if let's say there's none of this one-off fortunate or unfortunate thing that happened, how would the business perform? I'll probably look into that. I'll probably take that as my basis of valuation.
Thank you so much, Ian. Excuse me. The next question is by Bernard. Would you not consider calculating the fair value using the free cash flow approach?
Most Malaysian stocks, unless you know how to calculate free cash flow lah. Okay. In free cash flow, it's easier if you, I mean to say, my experience is that unless you look at some US stocks, maybe they calculate it for you. But for Malaysia one, you have to do your own calculation. So that means there's a lot more work when it comes to that. I'm not saying that you can't. It's just that number one is this lah. Number one is all based on your own calculation, which is subjected to mistakes and errors. Okay, that could be one aspect. And the second one is that you are talking about fair value ma. So when you talk about fair value, fair valuation is always an estimate. It's always a projection. So it's like today I value the stock. Let's say I value certain company at $10, but your valuation could be wrong, could be off by a little bit. So if you value something at $10 and it's at, let's say let's say the stock price now is at $8 or $7, it may materialize, it may not materialize. So it really depends. Okay, whether or not it will actually hit $10. But then the thing is that for me personally, I don't do that lah. All right, because I know that it's just an estimate. You can use that as a guide, but I didn't really use it lah. For me, I just focus on PE and dividend yield. To me, that's good enough already lah.
Yeah, all this. I think Warren Buffett is also a strong proponent of free cash flow, but free cash flow approach in calculating the fair value. But every analyst has their own set of assumptions when it comes to calculating all this, fair value of a company or intrinsic value of a company. If given the same set of financial data to Charlie Munger or Warren Buffett, both of them would arrive at the different numbers when it comes to calculating the intrinsic value. So of course, if you have the corporate finance knowledge, you can use this approach, to project the cash flow to the future and discount it back to the next present value using a relevant discount rate. Yeah, and then of course you can arrive at your own. But for retail investor, I think most retail investors may not have this kind of professional corporate finance knowledge. So I guess PE value would still be a more relevant metrics when it comes to using calculating the valuation.
Yep.
Next question is by Y Ying. How does one check the earning and valuation if buying ETF or the unit trust fund instead of the stocks?
Yeah, that's a good question. That's why I don't have ETF or I mean to say unit trust is how I say that's why I love stocks, because stocks you can get the 5, 10, 15, 20 years worth of annual reports. I love it because it allows me to study the company's finances, the management, and all these kind of details of a company before I decide whether I should buy or not. I'm not too sure whether I can get annual reports for unit trust funds or ETF for the past 10, 20 years. I don't know. All right. And because of that, right, I see stocks as being more transparent, more data, more transparent, more information for me to make decision. Therefore, I'm more of a stock guy than a unit trust guy. All right. So why in yellow? So when you ask this question, I also wonder, how do you check earnings and valuation? I don't. I mean to say some unit trusts, maybe they give you a semi-annual report or maybe an annual report, but some Malaysian listed, some Malaysian ETFs, they will give you the annual report. Yes, they will give you annual report. Sorry. So for ETF, yes, they give you annual report, but not so much about unit trust funds. All right. So unit trust funds, I do not know how to assess it, so I didn't really touch it. The only unit trust funds that I have are buy an investment linked policies, and it's like no choice. You're actually buying insurance, but then trust fund. Then that's how I own the unit trust. That's the only unit trust funds that I think I own today. So I didn't go and purposely go and buy units in the unit trust funds. When it comes to ETFs, all right, I didn't really study their annual reports. They do. The Bursa listed ones, they have annual reports. But how to study them? I think I have a way, or I can actually find a way, but I haven't done that study lah, because I'm more interested in stocks. Let's put it that way.
Yeah, if I may chip in,
Mm.
you can check out all these, funds information on the respective issuer website
Mhm.
or respective issuer channels.
Mhm.
For unit trust funds valuation, when you buy unit trust, you
Mhm.
definitely buy it at the NAV price, net asset value price,
Mhm.
after the end of day price. Okay, you definitely buy at end of day price, and you definitely sell the unit trust fund at the net asset value of end of day price. For ETF, you want to check the valuation, because ETF is listed on the exchange, so it is subject to the supply and demand on the exchange. So the price could differ from the NAV, although not too much. Sometimes they are traded at discount, sometimes they are traded at premium. So you will need to evaluate, are you buying it at a discount or you're buying it at a premium to the net asset value? The net asset values price of ETF are published daily on the issuer website, whereby I think the NAV of the unit trust are published quarterly, if I'm not mistaken. Okay. So every day you can check whether the ETF, they are traded at premium or they're traded at discount relative to the NAV before you purchase. On Bursa Academy, you can find the IOPV, which is indicative portfolio value. Indicative portfolio value. If I'm not mistaken, that's how it stands for. Yeah, so this is indicative portfolio value means this is their NAV, how much they are worth. So you can check on Bursa Academy to find what is the right valuation per share basis. All right, so that's my view on that lah. The next question by Zhishen. For average PE ratio, how many years of PE should be taken into account?
I use 10. Case by case, but in general, 10.
10 years. You have a pretty long time horizon.
Exactly.
Ling would like to ask, do you keep a worksheet for each stock you buy and update it manually every year?
Yes to the worksheet, but I tend to track their financial performance every quarter lah. Every quarterly I will track one lah. So yeah lor. You can say I have a worksheet for all the stocks that I have purchased, and of course for all the stocks that I am considering to purchase, and I will tend to update their financial data on a quarterly basis. Correct. So I use a lot of Bursa Malaysia stuff lah. I use a lot of stuff that is being presented on Bursa Malaysia website.
Okay, thank you, Ian. The next question is by Ui. As an investor, do you join the AGM and talk to the management?
The answer is no. This is because of okay lah. So there's this website called The Fifth Person. So it's actually a friend. I'm not too sure whether Shane, you know about The Fifth Person. I'm sure you heard of them. Not too sure whether you're friends with them, but they tend to come out with AGM articles. So these are people who are very rajin, They're very rajin. They go and attend AGMs, and then they write a summarized articles on their findings on these AGMs. So since they did so much work on traveling to that spot and write and come up with something, I just read their AGM articles. That would be more than enough. So for me, no lah. I don't go and attend AGMs and talk to the management. Not until that level.
All right, thanks, Ian. The next question is by Edmund. If a company has a lot of cash, but they have been making losses for the past 2 years, although the cash flow is still healthy, do you exit or you buy more when the stock price drop again?
A lot of cash. Okay, so that means a lot of cash but making losses. cash flow is still healthy. 2 years making losses, but cash flow is healthy. Depends on 2 years of making losses. It depends on what company lah. All right. It sounds like a certain company lah, but then it sounds like a certain group of companies lah. So I don't dare to put in I should buy or I should sell lah. It's all very investigative lah. I will need to actually look into it further before I decide. Buy more when the stock price dropped by 80%. I kind of like suspect what kind of company is this lah. But then, so because of that, I won't actually. I think to say, I won't give you a definitive answer of but yes or no lah. Because I kind of like guess what you are trying. I kind of like have a good bet or a good guess on what kind of company this is lah. So, do more study lah. I mean to say, I probably will do more study in order to answer this kind of question.
Thank you so much, Ian.
Yep.
The next question is by Simon.
Mm.
How do you compare valuation when companies are doing multiple bonus stocks issue or stock splits?
Then you have to adjust. So when they do bonus issues or stock splits, then of course everything you have to adjust. Okay. So you make the adjustments and then you compare it. Then you make the adjustments and then you do the valuation. A bit lengthier, a bit more work, but then you just have to make the adjustments and then you just continue. You just carry on with the valuation adjustments.
But usually the market cap doesn't change, and the valuation shouldn't change much because it is just a share price that got adjusted and the number of outstanding shares that got adjusted.
Correct. So it's not. So like what she has mentioned, is really not, and that's not the. Doesn't mean that there's a. Oh, okay. So 10 ringgit times 1 share equals to 5 ringgit times 2 share is still 10. So it doesn't make a difference in terms of fundamentals and valuation.
So the next question is by Ui. When the share price of a company dropped 20% from its recent peak or from the highest price, would you take any actions?
Why need to take so much action? It's all based on PE ratio. So I don't know. So like just now, it seems very. It depends on the. Just now when I explained the first part. Okay, so like the first part here is says. Let's go back. Okay, what do you think is good performance or bad performance? And then if let's say you say it's based on stock prices, whereby stock price dropped 20% from highest. So the thing is that why are you looking at it from a stock price angle? If you're an investor, maybe you should look away from stock prices. All right, focus on the fundamentals and the valuation. Then from there, I think you can have a better answer lah. But there's a caveat to this. You are only in because you are investing. If you're trading or if you're speculating, then I don't know. Then you shouldn't be relying on whatever that has been presented here, because I'm not a trader and I'm not a speculator, so I won't know.
Thank you, Ian.
Yep.
The next question is by Sam. Assuming that there's a company that pays dividend, however, the minus is that the company has a negative cash flow. So would you hold on for the share? And if yes, then would you hold on for how long?
First, this is something very important. Cash flow must be positive one, cannot be negative. See, okay, so cash flow statement, let me just explain. There are 3 parts to it. The first one is the cash flow from operating activities. Operating means cash flow that is generated from customers, business. Okay, so that's the first part. If that is actually positive, then the company can do two things. Number one, the company can invest into growth activities, okay, to actually increase the income productivity of the stock. So that will be cash flow from investing activities. So operating activities can fund the investing activities. That's the first thing that the company can do. And the operating activities can also do another thing, which is the fund, which is to do the next thing, which is to pay dividends. And dividends are usually reported under cash flow from financing activities. Now, I will prefer a stock whereby the dividends are paid from operating cash flow. If the dividends are, if let's say we have a company that pays dividends, but then you look at the operating cash flow, it's not positive, leh. Okay, this company, for so long, it hasn't been generating consistent positive. It hasn't been generating positive operating cash flow consistently, but yet its dividend is very consistent. So the question is, where is the source of these dividends? It could be from its borrowings. It could be from raising capital from investors. So if let's say, for example, the dividends are actually paid out of money raised from investors and from banks, but not from customers, I will not want to invest in this company. That's my take.
Thank you so much, Ian, for the clarification.
Hmm.
The next question is it important to do valuation on return on invested capital, ROIC?
Okay, so return on invested capital, it depends on your style, what you are looking at. So if let's say, because it actually kind of like involves more calculation. So it depends whether or not, number one, is it efficient for you to calculate return on invested capital for a company? So that's one. If yes, then good. If no, then no. All right, that's one. For me, I didn't really calculate that because the thing is that I didn't really use that as my metrics to measure a stock's income productivity lah. But for some investors, especially those who are more towards, they are not so much about dividends, but they are more towards, let's say, for example, business growth kind of investor, then maybe they will actually measure return on invested capital lah. But to me, I would say that this one, it actually depends on individual investors themselves lah, individual preferences. So my take is no. At least for me, but can't say for other investors. But there are investors who do that. Maybe Casey Lau. Okay, who knows? He likes return on equity. Then that's actually quite close to return on invested capital. For him, that's important. For me, may not be. So that could be our differences.
All right, thank you so much, Ian. I think generally, at the retail investor standpoint, PE ratio is more like a metrics to evaluate the valuation. But of course, there are many investors who will look at ROE, like return on equity, like you just mentioned, to get a sense of what is the return on equity if I were to invest in this company. So if you want to use ROIC, I think it depends on whether you find that, whether this indication of how well a company is using its capital to generate profits, if this is very important to you, or then you use return on invested capital, because it would help you to assess whether this company, whether they are efficient in allocating their capitals to generate profitable investments. So if you find that it's important, then you use it. But generally, I think more people use ROE instead of ROIC. So it depends on you. Hope we answer Jeff's question.
Okay.
If I can't get the past 10 years annual report, where can I get the past 10 years financial information? So this is a question by Cole.
First, if you're looking at Malaysian companies, there's no way, very much no way. It's quite impossible that you cannot get the annual reports. Sure can get one, but some Malaysia got one. Because almost every day I look at that website. So I kind of like So I kind of like almost say with certainty that you can get the stocks annual report from Bursa Malaysia website. That is actually one of the very important functions of Bursa Malaysia website. Two, I would say that is how Bursa Malaysia contributed to me as an investor. It's a place where I can get all the annual reports. If let's say that website couldn't, then not too good lah. But the thing is that for Bursa Malaysia, they are very good. I can get the quarterly reports, I can get the annual reports at my fingertips very easily, no issues. So don't worry about this. You sure can get one. Unless the stock is not listed for more than 10 years, then you get up to its IPO document.
All right. Thank you so much, Ian, for doing this wonderful session for us. The time has run out, so we got to close our question and answer session.
Mm.
All right. So thank you so much, Ian.
All right. Thank you so much. It's always a pleasure to be here.
So for our next Bursa webinar, it is titled Inflation and the Sectors to Benefits. So it's happening on 12th April 2023, Wednesday, 8:30 to 10 p.m. You can click the link here to register. I just given you the link. So if you want to learn what is the impact of inflation and what sectors could benefit from this inflationary cycle, please register for this webinar so you will learn from our speaker on where he sees the opportunities. So with that, I want to thank all of you here for staying tuned until the end of this webinar. I want to thank Ian Tai from kcloud.com to share with us on this topic. So thank you, everybody, and I hope to see you in our next webinar. Bye.
Thank you so much. Goodbye.